Have you ever wondered why high net worth individuals pay less in taxes even while earning millions? It's not about loopholes. It's about understanding the rules of the game, rules that were written to be used, not feared. In this video, you'll learn how the wealthy legally leverage the tax code to build and protect generational wealth, and how you can begin applying some of the same strategies, even if you're just getting started. Stick around until the end. We'll reveal the single most overlooked wealth-building tax strategy almost no one talks about. Let's start with a hard truth. The tax system is not built to reward workers. It's built to reward investors, business owners, and strategic planners. That's why someone earning $50,000 from investments can legally pay less in taxes than someone earning $200,000 in a W-2 job. The wealthy don't just work hard, they make their money work smarter, taxed in ways that reward long-term thinking and risk. To understand how the wealthy save on taxes, we need to look at income categories. There are three: earned income, W-2 jobs, portfolio income, stocks, dividends, capital gains, and passive income, real estate, royalties. Earned income is taxed the heaviest. Portfolio and passive income often qualify for lower long-term capital gains rates or even deferred taxation. Wealthy individuals shift their income sources strategically into those lower taxed categories. For example, instead of taking a large salary, a business owner might take a modest wage, and the rest as distributions or dividends, often taxed more favorably. That's intentional planning, not luck. Now let's talk about business structures. Wealthy families don't just own things, they own them through entities. Holding companies, LLCs, and S-Corp allow them to separate income, deduct legitimate expenses, and manage risk. An LLC that owns real estate can deduct depreciation, property taxes, repairs, even a home office. For example, let's say you earn $100,000 in rental income through an LLC. After depreciation, interest, and maintenance costs, your taxable income might only be $30,000 or less. That's the magic of entity-based tax optimization. Real estate is the tax code's favorite child. Depreciation lets you write off part of the property's value each year, even as it appreciates in the market. And then there's the 1031 exchange. Sell a property, reinvest in another, and defer paying capital gains tax indefinitely. This is how generational wealth is built. Property after property, tax deferred, compounding over decades. Pro tip: bonus depreciation and cost segregation can supercharge your write-offs, especially in the early years of ownership. This is what real estate moguls like Grant Cardone and institutional investors use to reduce their effective tax rate to nearly zero. Wealthy individuals never leave retirement savings on the table. They max out traditional and Roth 401ks and, if they qualify, use strategies like the Mega Backdoor Roth to stash up to $69,000 in tax-advantaged accounts. Roth accounts grow tax-free, and that includes compound interest, dividends, and capital gains. High earners also use health savings accounts, HSA, which are triple tax advantaged, and solo 401ks or SEP IRAs for side income and small business activities. That's tax sheltering at every level. Timing is everything. Deferred compensation plans allow high earners to push today's income into future years, when their tax bracket might be lower, such as during retirement. This lowers your current tax bill while letting investments grow behind the scenes. But be cautious. Unlike 401ks, deferred comp plans aren't protected from creditors or employer bankruptcy. That's why due diligence is key. Charitable giving isn't just generous, it's strategic. Donating appreciated stock instead of cash allows the donor to avoid capital gains tax and claim a deduction for the full market value. Tools like donor-advised funds or charitable remainder trusts make this even more powerful by spreading out deductions over time. Bunching donations, making multiple years' worth of contributions in 1 year, can help you surpass the standard deduction and maximize tax benefits. This is how ultra-wealthy families combine purpose with planning. So, what's the most overlooked tax strategy? It's proactive planning. Most people think about taxes in April. The wealthy think about them year-round, with expert CPAs, tax strategists, and legal teams who plan 6 to 18 months ahead. The good news? You don't need to be a millionaire to use these strategies. You just need guidance. That's where we come in. GavTax Advisory Services, a trusted advisory service specializing in tax planning for real estate professionals, business owners, and high-income individuals looking to save smarter and grow faster. If you found this valuable, hit subscribe, like the video, and turn on notifications. And if you want personalized guidance tailored to your financial situation, book a free consultation with our team.